Applying. In this example, we'll be using exercise 532, which can be found in your textbook on page 216. In this example, we're going to be calculating the predetermined overhead rate. We're going to apply it based on actual use of cost drivers, and we're going to reconcile at the end of the year. For this company, they tell us that they've estimated that their total overhead for the entire year would be approximately $486,400. The cost driver that they're using is direct labor hours, and they're anticipating that they would have approximately 95,000 direct labor hours in the coming year. They also give us what their actual amount of overhead and direct labor hours are. They tell us that just for the month of January, direct labor hours were $7,830. And before we've adjusted cost of goods sold was $707,000. The first thing that we need to do is to calculate the predetermined overhead rate for the company. We need to apply that rate for January, and then we need to calculate our total overhead for the entire year and determine if it was over-applied or under-applied. Based on that answer, we'll decide how we need to adjust our cost of goods sold. Remember, when we're calculating predetermined overhead rates, we're basing it upon our estimates. When we apply it based on the actual amount of cost driver consumed during the period given. So for part 1, we need to calculate that predetermined overhead rate, which again is our estimated total overhead divided by our estimated total cost driver. Don't forget that the cost is in our numerator, not our denominator. For our estimated amounts, they told us at the start of the year, the company estimated that they would have $486,400 in overhead, and that they were going to base that on direct labor hours. And their estimate at the start of the year was that they would have 95,000 direct labor hours. When we divide the two, we come up with a predetermined overhead rate of $5.12 per direct labor hour. In part 2, they ask us to determine how much overhead was applied in the month of January. They tell us in January that the company actually had 7,830 direct labor hours. Even though we've based it upon estimates here, we're going to apply our rate based on the actual amount of direct labor hours that were consumed during the month of January. So we take our predetermined overhead rate of $5.12 and multiply it by the actual amount of direct labor hours worked in the month of January. So the $5.12 multiplied by 7,830 direct labor hours. That tells us for the month of January, we applied $40,090 in overhead. In part 3, they want us to calculate the total applied overhead for the year. Be careful when you're doing assignments like this. Make sure if you're looking at it for a month or for the year in total. In this case, we're looking for the year. So we look back at the information, and it tells us that the company had actual direct labor hours of 93,500. We know that we use our predetermined overhead rate and multiply it by the actual amount of those direct labor hours. Therefore, for the year, we've applied $478,720 in overhead for the entire year. Notice that our estimates were not far off from the actual amounts. In part 3, we need to decide whether we were over-applied or under-applied for the year. They told us that we had actual overhead of $476,100. We need to compare that to how much we've applied for the entire year, which we just calculated in part 3 of $478,720. The amount of overhead we incurred was less than the amount that we applied. Therefore, we over-applied by $2,620. I want to point out, don't forget, when you're calculating your overhead variance, you are using the actual amount of overhead, not the estimated amount. We only ever use our estimates when we're calculating our predetermined overhead rate at the beginning of the year. We don't use them any other time throughout the process. Since we are over-applied, that means we actually applied too much cost, which means our cost of goods sold is over the amount it should be, meaning we need to subtract $2,620 from our cost of goods sold. Our unadjusted amount of cost of goods sold was $707,000. We subtract away the $2,620 to arrive at our adjusted cost of goods sold that would appear on our income statement of $704,380. As a quick tip, when you are looking for your overhead variance, always do it in this order. Do your actual overhead first and subtract away your applied. When you're over-applied, you will get to a negative number, telling you that you have to subtract it away from cost of goods sold. When our applied overhead is less, that means we're under-applied, and we would get a positive number here as our variance, telling you that you need to add it to your cost of your goods sold.